Before we start today's training, I wanted to take a few moments to talk about this. So there are multiple microphones in this room. We think it's like ones that are on circles. So it picks up a lot of what you were saying. So, and then that means it will be picked up on and everyone online will hear it, and then it'll be online in our YouTube video forever. So please, please refrain from talking super loud while we're presenting. That would help with the recording later. Speak up. Okay. Sorry, guys. Okay, I'm gonna yell. Hopefully, it doesn't sound like I'm shouting it. There's a camera in the room, and it's right there. I don't think anyone's gonna block it, but just be mindful if you're standing up and if your head is in the way, it's gonna be recorded. The temperatures in this room and in this building are still kind of a fluctuating phenomenon. So if it gets hot, we're gonna open the door and then put the fans on. So for now, we're okay, but probably after break, we'll have to put the fans on. Just still fading from that.
Directly into the mic.
Well, the mic is like right there. Let's try this. So we have everyone's mics muted on Teams. So if you have a question, please type it into the chat, and Bree's gonna read them out at the end of at the end of each presentation, and then everyone will get to hear the question, and then the person who's presenting or someone else will answer it. Okay. Better now. Okay, I'll shout this way. Welcome to the annual SARS year and close training. We're doing it a little bit different this time. As you can tell, we're doing it a hybrid.
Right there,
So most of
before including original CI, sure. This information.
it's like your mic should be muted. Who's talking? Okay. So we normally have about 80 people in person, and right now we have about 30 people. So drastically different amount of people that want to come in person. We got the message. We'll probably do this hybrid training again because I enjoy this. Let's see. So I wanted to start off today by doing a quick. And people who's this is your first year in close training for SARS, raise your hand in person or online. Just raise your hand if this is your very first one. Okay. Just wanted to get an idea of who's brand new and who's been here a million times. I will say for myself, I started in fiscal year 17, so that was my very first year in close training, and I was a tech, and I had no idea what I was listening to. It went way over my head, and especially the end of the Biennium budgetary information that Kathy's going to present, it was just, whoop. But every year it got better, every year it got easier, and I just want to say, just stick to it, and hopefully it might not make sense today, but take your notes home, and then next year it's going to make more sense, and the more you're practicing, the more you're training, and eventually it will all make sense. Hopefully. Okay. So today's agenda. After the introductions, I'll go over the SARS and OSC restructure, the agency resources, and then Olga's going to cover the year-end schedule. Kathy's going to cover the budgetary reporting end of the biennium, and after that section, we're going to take a break because it's one of the most heavy sections that we have. Then after the break, Alyssa's going to cover disclosure changes and updates. SEFA updates are going to be by Karen. GASB 101, correction of an error by popular demand. Heather is back. Talk about considerations for GASB 100. And then Brady's going to cover GASB 101 and 102 like that. And then I'll finish it off with what's coming from the Governmental Accounting Standards Board and from SARS and Office of the State Controller. Okay. Introduction. I'd like to introduce my team and myself. You're probably wondering who is this girl and where's Rob Hamilton? Oh, Rob Hamilton back. Well, Rob Hamilton promoted to the state controller and I took his position last June. It's been almost a year since I was the SARS manager. And for those that don't know me, my name is Valia Rizzo. I started SARS in 2022. And so some of you may know me as your previous SARS analyst. And before that, I worked for DAS since I graduated. So I've been a DAS employee for my whole career here. I'd like to introduce the rest of my team, starting off with the Senior Financial Reporting and Policy Analyst, Brady Stutzman. Right. And then we have our Senior Accounting Analyst, Alyssa Engelson. Heather Klein.
Heather.
And Sarah Longwell, who joined us in April. And then we have the accounting analyst, Bree DeLacy, who's going to be the MC today. Olga Fakina. And in the back, we have Smriti Pista, who you may remember from the advanced teaching training last month. So really quickly, I'll go over the restructure of the Office of State Controller and SARS, because I know that you're getting a lot of communications from both. They're like, oh, this is Office of State Controller. This is a SARS message. What does that mean? So SARS, Statewide Accounting and Reporting Services, OSC, Office of the State Controller. You may hear Controller's Office. It's interchangeable. So before Rob took over as the State Controller, the SARS unit consisted of the ACFR team, statewide accounts receivable management, system security, federal reporting, and travel. This was all under the umbrella of SARS. With the restructure now, SARS is sitting right here, and that is just the ACFR team. So everything got separated out. And so SWARM, which is statewide accounts receivable management, system security, federal reporting, and travel, are now under the Office of State Controller. So that's why you're getting things that say, this goes to the Office of State Controller, it's federal, it's travel. But SARS, the unit that does the ACFR, that's just SARS now. And as you can see, we now have the Deputy State Controller as part of the Controller's office. That's Fabiola Flores. And she has the whole, all of the managers and all the teams that report to her under her. So it's bringing in, we have a better collaboration now with SFMS, Statewide Financial Management System, Services, and OSPS, Oregon Statewide Payroll Services. And so we have the system side, which is SFMS, and then we have the policy and financial reporting side, which is SARS. And I think together, our collaboration, as you probably saw with some of the trainings that we do, we have the quick vids that both of our offices produce, the Office of State Controller, but it's a team effort between SARS and SFMS. And so I think going forward, you can expect to see more of that, more collaboration, more trainings that are combined, just statewide communications that go out, have a similar message, and just helping agencies with their questions, better collaboration within our team to better. Now to agency resources, I'll briefly cover some that I think are beneficial to you all this year in close. For those not familiar with our website, we have a number of useful resources that agencies make during year end close, but not including statewide balance reports, which agencies use to see if there's an imbalance between a transfer in, a transfer out, a due to, due from, based on the G38 code. And those are updated after every month close. And then during month 13 after June close, they're updated 3 times a week, Monday, Wednesday, and Friday. Then we have the agency guide to year end close, which is a very helpful tool. There's a lot of chapters in there that have a lot of, and Olga's going to cover part of it in up next. Then we have the disclosures. We haven't uploaded them yet for fiscal year 25, but we will by the end of June. And then they're see that they have the sample disclosures that will tell you exactly how you need to fill out the disclosure when you actually do it in. And then we have, of course, the Oregon Accounting Manual, which is a great tool. It has a lot of useful information that resembles the GASB standards, it's just in a more, it's in the OAM language. And then we have the training and resources, which I'll cover in the next slide. I already mentioned this, but the quick fits is a great way to quickly get an idea of how to do a transaction that's specific. For example, a lease commencement entry. So we have SFMS that's showing you how to do it in R stars, and then Brady's explaining from SARS explaining the fact pattern and how it's affecting financial reporting. So together you're getting a full picture of that entry. And it's quick and it's easy. You don't have to scroll through a bunch of, PDFs or training material. You can just watch a quick video and get what you're looking for. And what I wanted to say here is that we have a poll that so far we have 0 votes on. Zero. That means if just one person from your agency, that could be you, votes on any of those topics that you're interested in, it will vote it up. It will be the first one that we're going to do next. So the ball is in your court. See what we can do. And if not, we're going to continue doing what we think you guys want to hear. So you don't intervene, we're going to keep doing that. Hang on. If you have an agency that issues bonds through DAS Capital Finance has great resources that have the agency user guide on capital financing capital projects with XIT bonds. Very helpful guides. They're very thorough. They have examples of bond sources and uses that you would get for your agency, and then it shows you what the entries are, how to put the liability on, how to do just everything. Every part of that transaction is outlined in that guide. I highly recommend you check this. There's a link on the bottom where you can find it. And then from SFMS, Justin had asked me to share these from the SFMS May user group. There's a presentation PowerPoint and the YouTube video, very helpful resource. And then they also have a year-end guide and the biennium closing guide. Close research and verification. So check it out. It's provided here. Too short. Any questions?
Are there specific disclosures changing, or are all of them going to be updated?
There are some disclosures changing, and Melissa's going to cover that in her presentation. Okay, on the Up next, we have Olga with the year-end schedule overview.
I don't wanna.
Good morning. My name is Olga Fakina, and I will go this year and schedule today. It's very important to stay on schedule because it helps you to stay on track and avoid missing any deadline. We are going through today important dates and both start deadlines, our start processing dates, and useful OB report. The first important day on our schedule is June 11th, today, hybrid year-end close training. And for those of you who are here today, it's almost done. You covered. Good news. But for one who is not those here today, last day will be July 7th to watch and notify your start analysis. Next will be July 18th. Close of month 12, and it will be start busy days for agency, but also you can start your adjustment now. You don't need to wait until month 12. Moving forward, July 23rd was the deadline for agencies and universities to complete their initial confirmation of balances that are outstanding between them as of June 30, 2023. August 6th, final deadline for agencies and public universities to confirm outstanding balances between them as of June 30, 2020. August 8th, I would like to highlight this date, is soft close for month 13 and target date for all year end closing adjustments. And we are asking you to treat this day as your deadline because you will have spare time to double check your entries and adjustments, and also it will give your start analyst to make final check and resolve any problems that arise. August 15, close of month 13, last day for agencies to report year-end closing adjustments, and all necessary adjustments should be done by this day if it was not approved by your start analyst for any adjustment. August 22nd, deadline for submitting general and long-term debt disclosures and agency signed certification, and also deadline for submitting schedule of expenditures of federal awards, SEFA disclosures, and SEFA agency signed certification. Here is you can see our website where you can double check year-end schedule and agency guide to the year-end close entries. Also, you can, I included in our presentation helpful link if you have some question regarding year-end schedule and both start the date, you can see here, and also criteria for both start certificate. If you have any questions, please contact your start analyst. Moving forward, we are going through our start processing day. Month 12 will be start on June 1st and will be closed on July 18 and officially closed on July 18. And on the Monday, July 21st, you can pull out full report for month 12. Month 13 will be start on July 1st and go through August 15 and officially will be closed on August. Agency can request various start reports, which would become available Monday and Wednesday during month 13 after June close. Please use this report to identify and resolve any errors and discrepancies. The OB reports can help you. If you are not sure how was posted your entries, you can go to OB website and pull out reports and double check how it will record in your statement. You have 3 different types of data reports. Monthly report, which provides the last month close, period 13 reports, accessible year round, and year-end reports available specifically during the month 13. This is how they look like on OB website. Month report shows the last closed month tables as well as the corresponding month from the prior fiscal year. Period 13 report. This report is accessible year-round, and you can check your entries over there, but this report will be updated just on Monday. And year-end 13 reports. These reports will be updated 3 times in week during month 13. You can check your entries over there, but this report is just available during month 13, and most of the year it will be blank. Here you can see year-end general detail, year-end general summary, and year-end active accounting event. And these tables only available after month 12 is closed. Starting the Monday after close of month 12, July 21st, these tables are updated every Monday, Wednesday, and Friday until month 13. Thank you for your time, and please welcome Katie Watson. Yeah. Yes, that is correct.
So 113 was.
Do that online.
Sorry?
Reason is because month 12 closes July 12th. 18th, July 18th, 2 months will be open at the same time.
Yes, that is correct. It will be 2 months open same the time. Yes. No.
Welcome, everyone. My name is Kathy Watson, here to present the exciting topic we've all been waiting for, budgetary reporting at the end of biennium. By definition, a biennium only happens every 2 years, and we thought a reminder would be helpful. When transitioning from one biennium to another, the differences between generally accepted accounting principles, GAAP, and budgetary accounting policies become very apparent. Okay. Let's go. Here's a summary of the topics I'll cover today. General fund revenue and receivables, interfund transfers with general fund, expenditures, encumbrances, and commitments. My goal today is to provide you with the tools necessary to answer this question. And I still record this transaction in the 23-25 biennium. Let's discuss the difference between a fiscal year and an appropriation year. I like to think of it as accounting hat versus budgetary hat. There's your accounting hat on the screen. A fiscal year begins July 1st and runs through the following June 30th every year and is identified by the calendar year in which it ends. Generally accepted accounting principles provide the basis to determine which fiscal year a transaction should be recognized. Appropriation year begins on July 1st of an odd number year and continues until June 30th of the following odd number. Is also identified by the calendar year. For this presentation, I'm only talking about the budgetary general fund appropriated funds that begin with 8. Budgetary general fund revenue is recognized in the appropriation year in which the cash is received. There is no accrual of revenues in the general fund for budgetary purposes. It's strictly recorded on a cash basis, with the possible exception of some entries of the Department of Revenue for capital boosters. However, for financial reporting purposes, an accrual will take place. We'll see examples of this on the slides that follow. These budgetary guidelines do not apply to all fund types, only to the general funds. These rules are critical because of the calculation done to determine if the general fund revenue is sufficient to trigger the kicker, which I'm sure you're all familiar with. Revenue recognition for federal, lottery, and other funds are not addressed in the budgetary chapter of the Biennium. Here's an example. An agency receives general fund revenue on July 5th. for an amount owed to the state on June 30th. This scenario, the timing crosses both the fiscal year and the appropriation year. For budgetary reporting purposes, this revenue is recorded in AY 27. However, for financial reporting purposes, this would be considered revenue in FY 25 and should be approved. For financial reporting requirements, accrue the revenue in month 13, FY 25 and AY 25. This entry will automatically reverse in month 1 of FY 26. The end result of this entry is revenue is recognized in FY 25. GAAP, 0 impact to revenue for AY 25. Budgetary purposes, record the general fund cash in month 1 FY 26 and AY 27. Auto reversal is recorded in FY 26, and thus there's a 0 net impact. You have document supported general fund receivables that will not be collected by June 30th. You'll need to move them to the new biennium. We have an example of this on the screen, the T codes, and you'll have these slides available to you later for your help during a month-end close. Non-document supported receivables do not need to be moved to the new biennium. Let's look at an example to see why it's necessary to move receivables. Let's say in AY 25, you recorded an entry which recognized revenue that you now know will not be received during AY 25. Following steps will show how to move the general fund accounts receivable forward to the new biennium. First, you'll need to reverse the accounts receivable that was established previously in month 12, FY 25, AY 25. Do this with a T code 18. Next, in month 13, AY 25, FY 25, accrue the receivable for financial reporting purposes. This entry will automatically reverse with a system generated entry. Step 3, reestablish the document of supported accounts receivable in the new biennium in month 1 of FY 26 and AY 27. This effectively moves the document supported general fund accounts receivable forward to the new biennium. Finally, when the revenue is collected, record the cash revenue and liquidate the accounts receivable in F6 and AY 27. After all the transactions are complete, we will have accrued revenue reported in FY 25. The auto reversal will result in a net 0 effect to the revenue in AY 25. A document supported accounts receivable that is moved from AY 25 to AY 27. And finally, general fund cash revenue that will be reported in AY 27. The event is necessary to record a reduction of revenue. First, determine if the biennium is open or closed. The biennium ends on December 31st. If the biennium is open, report the reduction of revenue in the same appropriation year as the original revenue was posted. If the biennium is closed, it will have to be recorded as an expenditure. Remember, this is true for all appropriated fund types, not just general funds. If you have interfund transfers that involve a transfer to or from the general fund, it must be recognized in the appropriation year the cash is moved. If cash is moved July 1st or later, it must be recorded in the new biennium, AY 27. Both sides of the transaction must be recorded in the same biennium by both agencies or both funds for statewide balancing purposes. Let's look at an example. Agency A collects general fund revenue on June 27th, but does not transfer the money to Agency B until July 3rd. Agency A would record general fund revenue in month 12 of FY 25 and AY. Because the transfer did not occur until July 3rd, Agency A will also record a general fund transfer out to Agency B in month 1 FY 26 and AY 27. This is done with T code 720. Agency B will record a general fund transfer in from Agency A in month 1 FY 26 and AY 27. And for reporting purposes, an entry by each agency is also needed to accrue the general fund transfer in month 13 of FY 25 and AY 25. This accrual will be offset by an auto reversal, which will also post to AY 25, resulting in a net zero effect to interfund transfers in the current biennium. Let's look at the entries. Agency A accrues the transfer out to Agency B. Agency B accrues the transfer in from Agency A in month 13, FY 25, AY 25. 919 and 920. Remember, a transfer of expenditures using T codes 415 and 416 is not an interfund transfer. Rather, it's a movement of expenditures and cash from the fund where the expenditure was paid to a more appropriate fund within the agency. I like to think of it as a journal entry from my prior life before state accounting, statewide accounting, just a journal entry to reclass. The movement of expenditures must be recorded in the same appropriation year and the same fiscal year as the original expenditures. For example, on June 25th, the general fund at your agency paid for expenditures that are actually in other funds budget item. On July 24th, after the close of June in SFMA, the expenditure is moved from the general fund to the fund budget. Since the gap fund for the two D23 funds is not the same, the agency must record entries to move the expenditures in month 1, FY 26, AY 25 for budgetary purposes, and accrue the movement of expenditures in month 13, FY 25 for financial reporting. To record this movement of expenditures, use T code 415 in the other fund in funds in AY 25 and T code 416 in the general fund, also in AY 25. The biennium is still open. The debits and credits will cancel each other out, but the expenditure is now appropriately recorded in other funds in the current biennium in AY 25, the year of the budgeted expenditure, and just as important, the appropriation year of the original expenditure. Record an entry in the other funds and in the general fund in month 13, FY 25, AY 25 expenditure, and recognize a due to and due from between the funds. This is with T codes 925 and 926. Now let's talk about expenditure recognition. As a reminder, this applies to all budgetary fund types. In order to charge obligations against appropriation year 2025, the services must be performed or supplies received by June 30th, and the vendor must be paid by December 31st, 2025, the end of the current biennium. Go with me. I don't see anybody falling asleep. Can't see you online. Encumbrances are defined in OAM Chapter 20 as a formal commitment to purchase goods or services within the current biennium. Encumbrances are first and foremost an obligation that's recorded as a liability. And two, there was a recognition, there's an intention to liquidate the liability with financial resources of the current biennium, AY 25. Even if there's a signed contract for goods or services, but by June 30th, the contract has not been fulfilled, the encumbrance is no longer valid for AY 25. Will not be able to charge any more expenditures to the 23-25 biennium. And as a reminder, encumbrances at the end of the biennium need to be 0. You'll need to review all your outstanding encumbrances. For those that are no longer valid, record entries to eliminate them for financial reporting purposes. For goods and services received by June 30th, liquidate the encumbrances and record a liability. For goods and services not received by June 30th, either cancel or eliminate and move the encumbrance to the new biennium and disclose it on a commitment. As a commitment. In the event you determine that there are invalid encumbrances, eliminate them for financial reporting purposes with T code 931R. This entry will auto reverse in month 1 of FY 26. Later, if the encumbrance is still outstanding, the encumbrances canceling program will permanently remove it in December. Couple of different scenarios here. First, if you have goods or services and the invoice received by June 30th, and you have received an invoice during month 13, you will record an entry to accrue the payable using T code 225. The effect of the transaction will be that an expenditure is accrued for FY 25 and AY 25 with an offsetting liability. The encumbrance will be liquidated and removed. If the goods or services are received by June 30th, but the invoice has not been received by the end of month 13, the obligation becomes a liability. Record an accounts payable accrual in month 13 using T code 437. However, do not remove the document supported encumbrance. Instead, record an additional entry for financial reporting purposes to eliminate the encumbrance. This additional entry will offset the document supported encumbrance that was initially reported. In month 1 of FY 26, the system will auto reverse both entries and post them to AY 25, the appropriation year the initial entries were recorded. The net effect of these transactions are the obligation is recorded as an accrued expenditure in FY 25 and AY 25 with an offsetting liability. For financial reporting purposes, the encumbrance for the obligation is eliminated for FY 25. For budgetary purposes, The document supported encumbrance is still on the books as an AY 25 encumbrance. Now, let's look at the payment. Assume the invoice for goods and services received by June 30th finally arrives in September, and payment is made on September 15th. At this point, month 13 has already closed, and months 1 and 2, July and August, are also closed for fiscal year 26. Record the entry using T code 225 in FY 26. However, since the goods or services were received by June 30th, it would still be recorded into the current biennium, AY 25, prior biennium. So. 25. SARS generates T code 380 to liquidate the voucher payable when the warrant is issued. In this case, month 3 of FY 26 and AY 25. The net effect of these transactions are the cash expenditure is recorded in FY 26 or AY 25 and offset by the automatic reversal of accrued expenditure and the document supported encumbrances. This last scenario is where the goods and services are not received by June 30th. I said there are two options to address this issue for financial reporting purposes. You can eliminate or cancel the encumbrance. However, if your agency is still planning on making the purchase of goods or services, an entry will be necessary to reestablish the encumbrance in the following biennium. This is done with T code 212. The effects of these transactions are document supported encumbrance is removed from AY 25 and reestablished in AY 27. And note the commitment needs to be reported in your disclosures. That's general disclosure 14. Now let's talk about commitments. What is a commitment? They represent obligations related to unperformed payments that are not encumbered. They're not expected to be paid with the current financial resources of the current fiscal year. They are not reported in the financial statements as a liability. They are disclosed in the notes. I go phone. I think so. Okay. For fiscal year 25, report commitments for goods or services contracted for that have not been fulfilled by June 30th. And they are received, they will be paid for out of the AY 27 budget. Here's some commitment examples. They're generally long-term contracts or agreements associated with grants, loans, and or capital construction. Don't blame me. There we go. What's the difference between a commitment and an encumbrance? An obligation can be either an encumbrance or a commitment, but not both. Not duplicate it. for reporting purposes. This especially applies to the first year of biennium when encumbrances do not need to be eliminated. You can find more information about commitments and encumbrances in the OAM, or if your situation is not clear, please contact your friendly and knowledgeable SARS analyst for assistance. AMs are listed on the slide. It's 50.00. Encumbrance is 2020. Thank you for the. As a reminder, if you're using balance type 33 grant commitments to track your grant activity, please be sure to record those commitments in general disclosure. Reduction of expense is used only in special circumstances as defined in the OAM. Some examples include refunds for overpayment, purchase rebates, job rotations, reimbursements for hosting special events, or insurance recoveries, to name a few. Remember, the reduction may not exceed the actual expense and must occur in the same biennium as the original expenditure. If the expenditure was made from the general fund and the AY is closed, contact your SFMS analyst for steps needed to revert the money back to the general. For additional information about budgetary accounting and reporting, please refer to OAM Chapter 20. A link to the chapter is available at the bottom of this slide. If you have any questions, feel free to contact your knowledgeable SARS analyst. Does anyone have any questions? Thank you all for your attention and time.
I'm sorry for interruption, just for clarification, because it was not clear. Maybe I have a feeling. So month 12 will be start on June 1st and continue July 18th. And month 13 will be start on July 3rd and continue August 15th. Yes, 2 months will be open from July 3rd until July 18th. You can make both entries for month 12 and month 13. Thank you.
You said July 12th, Olga, is when month 13 opens?
No, July 1st.
No, July 1st.
July 1st.
Okay, cool.
Yeah.
Thank you. For some reason, I thought it was in the middle. Sorry about that. Thanks.
It's good. Thank you.
All right. Just going with the flow.
It's fine. It's okay.
Fine. Everything's fine. Okay, so made it to the halfway point about, so it's break time. Let's do about 15, let's do 15 minutes because I think we have some time. So that's not too long. We'll see each other back at 10:05. Okay. The bathrooms are, if you exit through these doors, they're to the right and then to the left, and then you'll see a whiteboard that says restrooms, because we don't have restroom signs yet.
Are we muted for now?
I almost feel bad interrupting you because I love the chitting and the chatting that's happening right now. Okay, so up next we have Alyssa Ingleson with disclosure changes and updates.
All right. Hi, everyone. My name is Alyssa Ingleson, and I'm here to present the disclosure changes and updates portion of the year-end training. This presentation will mainly focus on general and debt disclosures. First, I'd like to start with a question. Why are disclosures important? The general and debt disclosures are important as they assist us at SARS in the preparation of the annual comprehensive financial report, also known as the ACFR. SARS has 90+ agencies to receive information from, and we use this information to prepare our financial statements and notes to the financial statements. This process is also important because receiving accurate and complete disclosures from agencies is a criteria that SARS reviews for when considerations are made for awarding the gold star to agencies. I hope this presentation proves useful in helping everyone here with our upcoming FY25 disclosure process. Now onto the fun stuff. So today we're going to talk about changes that were made to general and debt disclosures, as well as some updates and considerations. So there were a few changes to general and debt disclosures in FY25 from their FY24 versions that we'd like to share. The first update is the instructions for General Disclosure 7. I will elaborate more on this on our next slide. The second update relates to conditional formatting. General disclosures 2, 5, 6, 7, 10, 34, and 37 were updated with conditional formatting that will highlight a cell red if the incorrect signage is used.
Oh, I love it.
Awesome.
So, for instance, if a number should be bracketed and it is not, the cell will be highlighted red until the signage is fixed.
I like that.
Debt disclosures 2, 3, 4, and 5 were updated with the same conditional formatting for signage. And 34 were also updated to have conditional formatting added to ensure that the total principal payments on tab E agree to the ending balance on tab F. I will have an example to share in just a few slides from now. Finally, I will have a visual example for you to see how the new columns look on general disclosures 10F and 34F, as well as the new transfers and adjustments column in general disclosure 37 later on in this presentation. The main change to disclosure 7 that we'd like to highlight today is a focus on excluding GASB 87 and 96 commencement entries involving GL 1551 from the increases and decreases section of this disclosure. In the entries guidance for lease and SPEDA commencements, we advise agencies to book a 908R and a 909R to recognize lease and SPEDA proceeds and the acquisition of the asset. In the 908R and 909R, GL 1551 is used just to balance the entry, and the total effect to this GL nets to 0. So while we highlight GASB 87 and 96 commencement entries, anytime GL 1551 is used to balance an entry, please do not include it on this disclosure. Next, let's chat about that conditional formatting everyone is excited for. Let's chat specifically about General Disclosure 10. Please note the same conditional formatting has been applied to General Disclosure 34, but for the purposes of an example, we'll just be showing Disclosure 10 today. So let's start with Disclosure 10E on the left of the slide. You'll see in the interest column, there's a cell highlighted red. We've labeled this number 1. This cell is being highlighted red because the sign is wrong. The amount should be bracketed like the rest of the interest that is reported. and the red highlight will go away once the signage is fixed on this cell. Next, on to disclosure 10F on the right of the slide. Let's chat about the cell highlighted red that is labeled number 2. For this instance, the ending balance does not agree to the total principal payments on the lease repayment schedule on disclosure 10E. The way the cell highlight will be resolved is ensuring the ending balance reported on 10F agrees to the total principal payments on disclosure 10E. Finally, on disclosure 10F, the item labeled number 3 relates to the ending balance that is highlighted red because the activity that is currently being reported on in disclosure 10E is for the government-wide reporting fund type, and the $2,000 that's being reported under an enterprise fund gap type. It's important to ensure that the gap fund types on disclosure 10E is the same as the gap fund type being reported on in disclosure 10F. Two new columns were updated in both disclosure 10F and 34F. For disclosure 10F and 34F, post-close adjustments was replaced with terminations in the adjustments column of the schedule of changes in outstanding lease and SPEDA obligations. This update was made since the beginning balance reported on 10F and 34F should agree to the ending balance on the prior year disclosure. Any post-close adjustments from the prior year should be reflected in that prior year disclosure. Terminations can now be included in this column and should be included in detail with dollar amounts in the adjustment description box at the bottom of the disclosure. For the lease entries guidance, modifications include a 908R with comp object 1700 to recognize lease proceeds and a T code 462 with comp object 1700 to adjust the lease liability. Modifications were added to the additions column of the schedule of changes in outstanding lease and SPEDA obligations so that all activity booked with comp object 1700 can be captured in this disclosure. For the SPEDA entries guidance, T code 908R and 462 use comp object 1701. Modifications were added to the additions column for the schedule of changes in outstanding SPEDA obligations for the same reason as leases. A visual representation of how these amounts tie to the DAFR 6610 for governmental funds will be available later on in this presentation. Finally, let's talk about the change to disclosure 37. The primary change to general disclosure 37 was updating the column heading, which was prior period adjustments column, and it is now the transfers and adjustments column. We made this change because prior period adjustments are now corrections of an error. With GASB 100, there became a larger requirement for disclosures around corrections of an error. So while there may be one from time to time, we don't anticipate a lot of corrections of an error each year. And we didn't want to limit what type of activity could be disclosed, reported on this disclosure. Therefore, we decided to adjust the column title to read transfers and adjustments to allow a variety of adjustments and transfers to be accounted for on this disclosure. So there have been quite a few new disclosures over the last several years, and I wanted to take some time to highlight how there are some disclosures that tie together and some disclosures that have information that ties between tabs within a single disclosure. I hope this information will be helpful to everyone when completing their disclosures. So beginning balances reported on general disclosures 10, 34, and 37 should agree to the ending balance on the prior year disclosures. This may mean that the beginning balances on your FY25 disclosures do not agree to your DAFRs if there were post-close adjustments. Next, we'll take a look at an example for this for general disclosure 37. As an example, I'd like to highlight how beginning balances will be reported in general disclosure 37 for FY25. Since last year was the first year for this disclosure, we had agencies match their beginning balances to the DAFR 6620. For FY25, we asked that agencies have their beginning balance on this disclosure agree to the ending balance of their FY24 disclosure. This may mean that the balances differ from your DAFR 6620 if there were adjustments made in FY24. If you have any questions regarding your last year's disclosure or would like to confirm what copy is best to use, please contact your SARS analyst. So we have noticed at SARS that we have been preparing some reclassification entries for lease and SPEDA obligations after month 13 close. These reclassification act for entries are prepared when the balances on the agency's DAFR 6620 don't align with what the balances should be. We'd like to encourage agencies to review their current and non-current balances during month 13 and incorporate that review into your year-end close processes. Now, let's chat about some considerations for specific disclosures. Let's discuss the purpose field for general disclosure 2. The purpose on the disclosure should be related to the purpose of the cash or investments being reported on, not the D23 fund title. Additionally, please aggregate the purpose disclosed by GL account. The example shown here is an example of this consideration. While this disclosure does have 2 customer deposit purposes, please note that there are 2 different GL accounts being disclosed, 0065 and 0070. Now I'd like to chat about the relationship between disclosure 8 and disclosures 10 and 34. If you have lease and SPEDA balances reported on general disclosures 10 and 34, general disclosure 8 needs to be completed. For this example, I'd like to highlight an example of correctly completed disclosures 10 and 8. This agency has completed general disclosure 10 with their lease repayment schedule and therefore has debt related to a fully completed project that needs to be reported in general disclosure 8. The 2025 principal amount of $92,045 is reported as the current portion on general disclosure 8, and the sum of years 2026 through 2029 agree to the non-current portion of the lease obligation reported on general disclosure 8. Next, let's discuss additions and modifications reported on disclosure 10F. On disclosure 10F, additions and modifications, new leases, reported for governmental funds should be equal to GAAP object 1800 on the DAFR 6610. Note, for proprietary funds and fiduciary funds, the lease activities are eliminated, so the additions for those fund types won't be able to be tied back to the DAFR 6610. Please just be sure to include just the additions and modifications made for those fund types on this disclosure in that specific column. Any transfers or other adjustments should be reported in that. Next, let's discuss deductions reported on disclosure 10F. On disclosure 10F, deductions or principal payments reported for governmental funds should be equal to GAAP object 7100 on the DAFR 6610. And similarly, for proprietary funds and fiduciary funds, the lease activities are eliminated, so the deductions for those fund types won't be able to be tied back to the DAFR 6610. But please be sure just to include the principal payments in this column. Any terminations should be now included in that terminations, transfers, and other adjustments. Next up in disclosure 10F. If there is a description in the adjustment box on disclosure 10, specifically tab 10F, agencies need to provide a specific dollar amount. Here is an example of an agency that had multiple adjustments and listed out the impact of each adjustment to the lease liability. Please note that the same logic should be applied to general disclosure 34, specifically tab 34F for SPEDAs. I'd like to highlight disclosure 34F, and while we just discussed this consideration for disclosure 10F, I wanted to highlight this since the GAAP object and comp objects are different for SPEDAs. Additions and modifications for governmental funds reported on disclosure 34F should be equal to GAAP object 1801 on the DAFR 6610. Similarly, deductions for governmental funds reported on disclosure 34F should equal GAAP object 7200 on the DAFR 6610. Next, let's chat about disposals reported on general disclosure 37. If there is disposal for an asset, there should be a disposal for the related depreciation or amortization account. It's also important to review and make sure that the disposal disclosed for the depreciation or amortization account is not greater than the disposal disclosed for the asset account. Here is another example of how amounts reported on multiple disclosures tied together. On the right is an example using general disclosure 37, and on the left, an example of disclosure 10F. What we'd like to illustrate here is that if there's an addition to leased assets reported on disclosure 37, then that amount should be greater than or equal to the additions reported on general disclosure 10F. For this example, we can see that $7,276 was reported as an addition to leased equipment and machinery on disclosure 37. And on the agency's disclosure 10F, $7,276 was reported as additions and modifications or new leases. Please note that the same consideration applies to disclosure 34F for SPEDAs and SPEDA assets. Finally, here's an example of specific dollar amounts disclosures in the text box of disclosure 37. Please make sure that you're including these specific dollar amounts if you're using this text box for FY25. Questions? Okay, up next we have Karen with SEFA.
Good morning, everyone. I'm Karen Williams, and I'm part of the Office of the State Controller, and I'm titling this SEFA section as We Learn as We Go, meaning that I don't want to make updates every year just for the sake of it. I recognize from last year's submissions that a few tweaks here and there in the wording could help with clarification and guidance in a few places. There's only one significant change to the SEFA disclosures, a new expense section for FEMA that we'll take a look at in the slides. And overall, most agencies did a fantastic job last year with submission of the SEFA disclosures. I started this position about 3 years ago, and I've seen each year SEFA reporting improving. And so I wanted to thank everybody for their efforts in doing so. So for the most part, this presentation will be more of a reminder for most, those folks that are new to the process, an idea of what the expectations are for SEFA submissions. At this point in time, no coding changes have been made to OB reports, so the presentation of the information will be consistent with prior years. As a reminder, the OB SEFA Express, and if applicable, the subrecipient expenditure report are to be exported to Excel, submitted with the SEFA disclosures. Each section of the Data Mart report, such as expenses, revenues, transfers, etc., should be on a separate tab within a single workbook. The SEFA Express YE is for agency use during month 13 and should not be submitted with disclosures, as the information can't be verified or used for research if needed after month 13 closes. For disclosure submissions, please be sure to follow the instructions provided on each disclosure page. No significant changes were made to the transmittal disclosure checklist or disclosure 1. So let's go ahead and skip ahead to disclosure 2. As a reminder, the SEFA disclosures are in Excel with tabs for each of the required sections. 2A is for expenditures. It did not seem clear to some agencies where the data mart amounts were to be pulled from when completing the disclosures. So the specific column names have been added and color coded in these examples. What does it mean? What's the difference? Although the information can appear to be the same in various columns, OB is telling two different stories with this layout. Column second from the right on the OB report identifies the funds used for expenditures that were received directly from the federal government, reported as direct award expenditures. Our right-hand column shows funds reported as indirect award expenditures. They were received from a non-federal entity and identifies the state as being a subrecipient of the grant. These distinctions are part of the information provided in the yearly single audit for the state. So if you can make out the numbers, you'll see that the total of the direct awards column is not the same total as the direct awards expenditure, 2.3 million versus 2.4 million. As promised, this is a look at the new FEMA disclosure. Disclosure tab 2B has been repurposed from revenue to FEMA expenditures. This section identifies specific FEMA expenses for a new footnote in the SEFA portion of the single audit. Revenue and transfer disclosure information has been moved to tab 2C. All agencies reporting SEFA will need to answer at least the first question, which is a simple yes or no. There can be a sizable time lag between an event and when FEMA makes a reimbursement. If the eligible expenditures occur in a prior fiscal year and FEMA approves the project in the fiscal year that's closing, the SEFA correction is required to record the prior year expense in the closing fiscal year's SEFA. The correction description should identify the entry as a FEMA prior year expenditure and the amount entered in the disclosure on the provided line. So that's basically it for disclosure updates. Let's go ahead and move on to corrections. Here's a portion of the SEFA corrections spreadsheet for expenditures. Only a couple minor changes have been made for FY25. A note at the top of the spreadsheet has been added as a reminder to use the precise contract number on corrections. For example, a 0, a string of 19 or 20 zeros, and a blank are not the same thing, and can cause unnecessary challenges if research is needed on an award. The highlighted subrecipient was removed from the upper section used to correct grant numbers, state fund groups, and such. All subrecipient corrections need to be entered in the lower section of the table to include the required tax ID and subrecipient name. The section of the table shows a FEMA correction that was made last year in FY24. The currently reported balance column shows 0 as there were no current year activity in the grant. The corrected ending balance column shows the amount expended in a prior year but was approved by FEMA in FY24. If the agency did happen to have a current year activity, the currently reported balance column would have reflected the FY24 activity, and the corrected ending balance would have been the current year activity plus the approved expenses, the approved FEMA expenses for the prior year. This next correction is an example of a situation that has happened at many agencies. An accrual is entered without identifying the subrecipient. Top table shows the OB subrecipient report where the omission is seen with empty fields highlighted. Table shows the correction. Correction is to zero out the entry without the identifying information and apply it to the appropriate subrecipient. This could be a one-to-one entry like this one is. Correction might need to be applied to multiple subrecipients. Because this subrecipient has a balance already recorded in the year, the correcting entry must take that into account. Currently reported balance column reflects the amount from the data mart report, and the corrected ending balance column adjusted to show the effect of the correction. You'll notice the net change in both entries is 0, so no change to the amount of expenditures on the grant. Subrecipient's amount has been corrected. Reporting accurate subrecipient amounts is important for subrecipient monitoring assignments made after the end of the calendar year. Wouldn't it be nice if they used shorter words sometimes? This is probably a good time to remind everyone that corrections recorded on the SEFA correction spreadsheet are for single audit reporting purposes only. They do not affect any balances in SFMA. So let's take another look at this entry. What happens if you discover a correction is needed, but you've already submitted one? Well, let's take a look at that. The top table is the correction we saw on the previous screen. Lower table is a new entry to adjust the accrual amount that was later discovered to be incorrect. The required information for the entry is the same. What changes is the currently reported balance column of the second correction. If you've already made a correction to the same grant and award contract number, corrected ending balance from the previous correction becomes the new currently reported beginning balance for this subsequent correction. Keep in mind, this is if the corrections are submitted at separate times. If the need for the accrual correction is already identified at the time of the tax ID correction, you'd include it in the corrected ending balance column in the original correcting tax ID entry. Net change to the subrecipient be an overall $10,000, and an explanation would reflect both changes. So I know that went a little quick. Are there any questions that could benefit the group? Okay, so please feel free to reach out to your SARS analyst or myself for any SEFA questions. I want to thank you for your time. And up next for your viewing and listening pleasure, Heather. Sorry.
We meet again to review GASB 100. GASB 100 goes over changes in accounting principle, changes in accounting estimate, changes to and within the financial reporting entry, and everyone's favorite, correction of an error. Changes in accounting principle requires retroactively restating financial statements for all prior periods presented. It also requires disclosure 24. Changes in accounting principle mean going from one GAAP to another or a new authoritative pronouncement. Changes in accounting estimates are recognized in the reporting period in which the change occurs. These are changes in inputs, data assumptions, and your measurement methods caused by a change in outputs. Examples. Nothing's changed from last year. We don't expect changes to or within the financial reporting entities to affect state agencies. This is the information if you need it. And everyone's favorite, corrections of an error. This requires retroactively restating financial statements for all prior periods presented, as well as disclosure 23. Corrections of an error
include things like mathematical mistakes and accounting principle application mistakes. If you're moving from a non-GAAP to a GAAP principle, also a correction of an error. GASB, in their infinite wisdom, has given us a get out of restatement free card. They have direct quote from GASB that is on their pronouncements. Visions of their statements need not be applied to immaterial items. You are welcome to go to the link and read the full text of any GASB pronouncement currently available. Now, I got a potato provision that we need to talk about. Auditors tend to not appreciate us using the word material. Auditors set materiality when they do their reviews. Word terminology is significant. I'm going to need you to hang on to that word. It will be significant in a moment. So something that I would like to just define, thank you. I need to stay entertained. Is FASB actually, and I'd like to read this, talks about materiality, okay, in their Statement of Financial Accounting Concepts number 2, qualitative characteristics of accounting information. In part, it states the omission or misstatement of an item in a financial report is material if, in the light of the surrounding circumstances, the magnitude of the item is such that it is probable that the judgment of a reasonable person relying upon the report would have been changed or influenced by the inclusion of correction of the item. So, when does GASB 100 apply to my agency? One of the first things you can ask is it significant? And just to be clear, FASB actually gives us some information on this. Per their Statement of Financial Accounting Concepts number 2, the omission or misstatement of an item in a financial report is material if the magnitude of the item is such that it is probable that the judgment of the person relying on the report would have been changed or influenced by the inclusion or correction of the item. Let's say you are still on the fence. We are going to ask ourselves, is it significant? FASB helps us out with a definition that states in part that the omission or misstatement of an item in a financial report is material, aka significant, potato, if the circumstances surrounding the magnitude of the item is such that it is probable the judgment of the person using the financial report is going to change their mind on their decision. Now, I know what you're all thinking. Heather, there's a lot of room left on this slide. She probably has another point to make. I can probably bet, and I'm not a betting woman, that you are all betting on what is coming next. And you would be right. And thankfully, FASB, in their Statement of Financial Accounting Concepts number 2, lets us know that an omission or misstatement of an item in a financial report is material if, in light of the surrounding circumstances, the magnitude of the item is such that it's probable that the judgment of a reasonable person relying on the report would have been changed or influenced by the inclusion of that correction.
Do we get a definition of a reasonable person then?
Can I morph that into a question as to what does significant mean? And if I can speak off the record, Thank you for that question. If I may speak off the record, or at least as off the record as a recorded presentation could be, let's go hypothetically. If we're speaking hypothetically and you are asking yourself the question, is this significant? Your hypothetical threshold would have hypothetically 6 digits before the decimal place. And also hypothetically speaking, the first digit of that number, reading left to right in case anyone would like to get sassy, would be something other than 1. Again, I am not here to set significant thresholds for your agency. However, hypothetically and off the record, if that information helps, you're welcome. Any other questions? Then, if you do or think of something later, you can contact your brilliant and very significant SARS analyst at their email addresses on this slide. I'm going to leave you in the best of hands with Brady for GASB 101 and 102.
Let's try and follow that. Thanks. So I am Brady Sutzman. I will be going over GASB 101 and 102 updates. First, so for fiscal year 25, there's a couple new standards that will be implemented. GASB 101 is compensated absences. First, we'll go over that and also what's changed and also what does that mean for agencies. Next, we'll talk about GASB 102, which is certain risk disclosures. So, state of Oregon only used vacation balances in their calculation for compensated absences in the past. Because mainly this was the only balances that were paid out at termination. So the standard has been updated. It's got a new definition, and so I'll read that for you here. It means now that leave for which employees may receive 1 or more cash payments when the leave is used for time off, other cash payments such as payment for unused leave upon termination of employment, or non-cash settlements such as conversion of defined benefit post-employment. So the standard also provides significant guidance on what other leave types should be included now, depending on when and how it's paid, as well as other types of new government policies that may have been implemented more recently. The main example of that is unlimited leave or other things like that. So now we're going to include sick leave, comp time, and governor's leave in addition to vacation. So this is significant because sick leave is a very large balance. And so it made the estimate for the change much larger. You'll notice that the amounts that each agency has to read. So moving forward, how do we calculate this? Since sick leave isn't paid out at termination, unless you're tier 1 or tier 2. Before we used actual balances for vacation, and now we need to somehow use an estimate. So the standard used a metric of what is more likely than not, and that's kind of been my world. But what does more likely than not mean, and how do you calculate that? So several different ways to calculate what's more likely than not. We tried different routes, but kept hitting roadblocks for various reasons. We tried using actual balances as we used in the past. We tried using a weighted average. We tried different sampling methods. Eventually, we landed on one way of sampling the data to estimate this amount. The Governmental Finance Officers Association, or GFOA, provided a couple different sampling methods. And so we went with one of those. And that's the one here. This one's actually called the dollars paid approach. So you'll see, we'll go over this a little bit over the next couple. So we won't go into too much details of what the sampling method is because it's kind of involved. So don't worry about grasping everything on the slides, but I'm just trying to give you a look. So to complete this, we had to receive several reports from Workday. One report included all employees terminated during the fiscal year. We split this report into 5 different populations based on their PERS status. So tier 1, 2 versus observed termination reason, whether they retired or quit. And then other leave codes that might be included because they require different payouts and different salary payment percentages. So we also used those samples to, or we also use those populations to get a sample of the terminated employees to see what percentage of leave hours were paid out in cash versus what was used in time off. We also use those samples to calculate the average pay rate, which is seen here on this slide. This is just a snapshot of some of the individuals that we selected. This is only 6 of, I think this sample had 70 or 80 employees. You can see their OR number. It has their hire rate as of the hire date. It has their hire rate as of their termination date. And then it shows the average hourly rate and then their average daily pay. So then moving forward, we have to also calculate the estimated salary related payment percentage for each type of payout, whether it's paid in time off or paid in cash. So then for this portion, we're using the years of service and the accumulated unused leave in days in order to calculate the potential amount settled in cash or used as time off for each terminated employee. Okay, so finally, once we receive the percentage of hours paid in cash versus how much time off and the average pay rate that would we then extrapolate that amount against the same respective population for active employees. So here's what we are incorporating: the ending leave hours over on the right in the red box. That's the number of total hours for active employees that then we extrapolate the previous data to. And then the last part is here's the ending liability for this population down here on the bottom. We'll take this total liability and combine it with the other populations that we had. And then the sum of all of those would be the amount that's reported in RAC. So did you get all that? I mean, pretty quick, a lot in there. So what does this mean for agencies? Probably really the only thing you guys care about. Not much, which is actually good. Actually less work for you. So in the past with GASB 34, we were required to split out the changes in compensated absences between increases and decreases in the ACFR. So this is why we actually began using this spreadsheet over on the right. Hopefully you recognize it. With GASB 101, it allows us to net the balance now instead. So the spreadsheet's no longer required. I believe in 2018 is when the state switched to having to show the increases and decreases around that time. So although it's not required, we're still holding on to it and we'll still use it as a resource. We're going to make some changes to it and it will also be available for. So we know, I mean, mainly because we know agencies usually break out the entries by PCA. So our workbook is intended to help as a check for balances in GLs 1605 and 1718 in total when the entries are completed. So we created a quick example clarifying what I just described. And just a disclaimer here, this is just an example. We use fiscal year 23 and 24 as reference points. So don't make changes to fiscal year 24. This is only for adjustments moving forward, starting with fiscal year 25. So in fiscal year 24, agencies receive their agency workbook in an email from SARS, including the percentages for current and non-current liabilities. For fiscal year 24, the agencies record 65% of the liability as current and 35% as non-current. Okay, and also just another side note is that those percentages are going to change each year. This is just for the total adjusted amount of ending leave for fiscal year 24 is the 27,391 down there on the bottom. So then agencies will multiply the fiscal year 24 amount, the total, of $27,391 by 65% to calculate the current portion for GL 1605. And then they will also multiply, which equals the 17,804. And then we'll multiply that same 27,391 by 35% to get the total for GL 1715. And that's that $9,500. Now we find the difference between the current and non-current portions between fiscal year 23 and 24. The fiscal year 23 balances were pulled from the DAFR 6620. So since the current and non-current portions decreased from fiscal year 23, we would record a T code 440R to decrease the current portion and T code 442R to decrease the non-current portion. So then the DAFR 6620 should look like this once all the entries are done. Also, I wanted to mention real quick that you'll notice the name change in the profiles for GL 1605 and 1718. It now is compensated absences payable instead of before it was vacations. Obviously, because now it includes more than vacation. And that's GASB 101. Kind of sad that it's condensed 6 months of my work into 10 slides, but I didn't want to bore you guys too much. But it wasn't only me, it was actually Free and Valia did a lot of work on that. Just wanted to bring you into my world of pain for a little bit. Okay, so that was a tough one. This is the easier one. Certain risk disclosures with GASB 102. Standard focuses on potential risks associated with concentrations and constraints pertaining to governments. A concentration is a lack of diversity related to an aspect of significant inflow of resources or outflow of resources. And here's some examples of what those might be. And then constraints are a limitation imposed on the government by an external party or by formal action of the government's highest level of decision-making authority. And there's some examples of that. So of course, we did an analysis to determine the potential concentrations and constraints of the state of Oregon. So here's some questions that maybe you guys will know. What's the largest employer in the state of Oregon? Anybody know?
State of Oregon.
This one's pretty easy. What's the largest city or the largest population in Oregon? Surrounding areas. What's the top 2 industries?
For Oregon.
Oregon. I heard one, wood products.
Farming,
health.
like fruit and stuff.
Healthcare.
Oh, Salem Health, no.
Porting goods in and out.
Tourism.
Wind farms.
Uh,
The next guess.
This one was actually close to somebody on there said technology, and so I'll give you that one. Semiconductors, actually. So state of Oregon has about 48,000 employees. The next closest is Intel, which has 20,000, and Nike has about 15,000. I didn't verify if that was just Oregon or if that's in general. Nike probably has way more. So yeah, then obviously city of Portland, surrounding areas, semiconductors is the biggest industry with 21% of Oregon's manufacturing. Wood products are 12% of manufacturing. So then over on the right, constraints, no sales tax for Oregon. The income tax rates vary from 4.75 to 9.9%. And then property taxes average property tax rate is 0.93%. It's ranked 25 out of 50 in comparison to other states, so relatively low, actually. And then maximum allowable property tax rate is 3% of assessed value. So all of that, we determined that the state has a fairly diverse universe of revenues and expenditures, which minimize those constraints and concentrations that we determined there. So not applicable, which is good. That standard is more likely to be applicable for like smaller governments that might have like a mill or a plant that most of the employees work for. Or something like that. And that's it. Any questions?
All right, I'm looking at the time and I think we're gonna finish early. Okay. Oh, you guys wanted to be here. We can go all day. All right. So I will end the training by covering what's coming from the GASB and from SARS and the Controller's Office. Okay, so 2 new standards are coming out in fiscal year 26. They are GASB 103, the financial reporting improvements, model improvements, and GASB 104, disclosure and classification of certain capital assets. And they're both effective in 26, not 25. And from SARS and Office of the State Controller, we have the capitalization threshold increase and a new SARS and OAC website. I'll cover more in the next few slides. Okay, so this is a good representation of, this is from the GASB, and it's a potential level of efforts graph, and it shows how much effort it takes to come to implement these standards. So you could see that GASB 101 and 102, medium and small, and 103 and 104 are relatively the same size. Although it's more impact on us than it is on the agencies. I'll say that right off the bat. It's going to impact, SARS is going to do most of the legwork for them, but it will impact some agencies, and I'll explain. It will impact all agencies, but with the minimal, not too much. Okay, so for GASB 103, it's the financial reporting model improvement statement, which includes updates to the presentation and content of multiple sections of our annual comprehensive financial report, the ACFR. And so this standard will affect SARS more than it will affect the agencies, but I want to briefly talk about 2 of the more prominent sections that will affect agencies. And at this time, we don't know the entirety of possibilities that it's going to affect, but from just taking a look at the standards and reading them and making observations, it doesn't seem like it's the. So I'll briefly go over the management discussion and analysis, the MD&A, and the presentation of the proprietary fund financial statements. So the main change with MD&A with GASB 103 is the enhanced focus on the analysis and explaining the why behind why the government's financial position and results of operations are changed. So currently in our ACFR, we kind of, in certain sections, we say, this is the change from year to year. This is the percentage change. Now they want more explanations, more, why did it change? What actually happened? So what does this mean for agencies? This means that agencies will be expected to provide SARS the why behind significant changes in revenue, expenses, expenditures, and even large balance sheet items. So you may be thinking, don't we already do this? And their answer is yes, you guys already do this, but I think there's always room for improvement, and I kind of want to go over what we're really looking for. And I will say that this is not something we're expecting next year. We're expecting this already. This is just practice for when they're actually going to be an implemented standard, but what we're requiring of agencies has not changed. So I'll do an example of an MD&A.
And this is a typical email that you may get from your analyst saying, hey, special payments increased 200 million in fiscal year 24 compared to 23. And then we expect the agency to provide the why this change occurred. So an improper explanation would be saying the agency made more distributions to non-governments, comp object 6725 during 24, at fiscal year 24 compared to fiscal year 23. What's wrong with that answer?
You can pull that yourself, yeah.
It's just restating basically what the observation was, not really explaining why it changed. So then the proper explanation, this is actually an example from last year. And it's a shorter example than what was provided. So there was more detail. So a 10% increase in the average number of weeks claimed per claimant in fiscal year 2024, an increase from 3.16 weeks to 3.46 weeks. Then an increase of about $50 in the average weekly benefit amount in fiscal year 24, which would explain this increase. And then there was 15,000 more claimants in fiscal year 24 than the previous year, which also explains why this increase happened. And I'm not saying, hey, I expect you, every agency, to give us 3 bullet points minimum to answer why something changed. I'm saying just explain the why. And you may not necessarily know why in the accounting shop. So this answer came not from the accounting shop, it came from the program itself. The accountant emailed the program, said, I need an analysis of why this changed. And the program was able to provide this kind of response. So I'm not expecting agencies, accountants to be like, oh, I know everything, I know exactly what happened. You can ask other areas of your agency to give you that information. You just have to ask. So don't do this. Do the proper explanation and give us the why behind the increases and decreases that we're asking about. Now, the presentation of proprietary fund statements. There are new definitions of subsidies and as well as new definitions of what operating and non-operating revenue expenses are, as well as a new format of how the presentation will be in our ACFR and in your individual financial statements if you have proprietary funds. So this will be important for those agencies. So, oh no, I'm getting some nervous. All right. So what are subsidies? Basically, they're resources received or given from an agency or another fund where there isn't a direct swap of goods for money. And it's meant to keep fees low and cover costs. So for example, think of a transit authority. When you're riding the bus, you're not paying $25, $50 for that fare. The fares are relatively low because it's subsidized by taxes and grants. And so you pay less because of that. And so that keeps the fares low. So the thinking behind it for entities that rely heavily on subsidies, looking at just the operating income doesn't give you the full picture of what's happening. So now there will be a new subtotal below that, which I'll show on the next slide. So this presentation really shows how an entity is doing after accounting for the money that keeps the fares or rates down. So this is an example from GASB of what the presentation of the non-capital subsidies will look like in our ACFR and in your statements when you can see that we have operating income loss here. And then below that, we have non-capital subsidies, which has intergovernmental revenues, transfers in and out. And so that's a total non-capital subsidies. I promise we will explain this more in fiscal year 26 when it's going to be relevant. I just don't want to go overboard and go into so much detail where you guys are like, this is not relevant to me now. This is next year problem for us. Let's talk about it later. But this is just a preview of what will happen. Okay, so who's affected with this part of the standard? It's agencies that have proprietary funds and the ones that issue their own statements, because you'll have to have that presentation in your statements. And so just to quickly go over an enterprise fund, a proprietary fund consists of enterprise funds and internal service funds, and enterprise funds begin with A4 And internal service funds begin with the 5. So it encompasses all of them, those are proprietary. And how will agencies be affected? Right now, we're still in the beginning stages, obviously, so we're expecting new comp objects to be created for subsidies, but we're still trying to figure out how that's gonna look, so don't quote me on anything right now. And agencies that have their separately issued financial statements will need to have this presentation next year. And more information will come, I promise. This is just a little taste of it. Moving on to GASB 104 briefly. This standard is created for disclosure of certain capital assets, and some of you may guess what capital assets they want disclosure on. Leased assets in accordance to GASB 87, intangible right to use assets, public partnerships and public-private partnerships, the P3s, according to GASB 94, and subscription assets in accordance to GASB 96, as well as other intangible assets. So thinking like timber rights, water rights, and a new addition to capital assets held for sale, that's also going to be disclosed in our note. So the reason that this standard was created was to better describe to the users what in our financial statements, the information about certain types of non-financial assets. And so the GASB board did research, got feedback, and the users of the statements said that they look at government's statements and the position differently based on their assets. So like if you have leased assets versus you own a building, they're gonna look at it differently. And they wanted that information to be readily available to them when looking at our statements. So the impact to agencies right now is minimal. It's going to be maybe disclosure changes, having additional items included in our existing disclosures that will give us the information that we need about these capital assets. And then the presentation, of course, in your statements, if you have separately issued statements, you'll also have to have this presentation in your notes. So that is about it for GASB 104. And then what's coming from SARS and the controller's office. Exciting news about the increase in the capitalization threshold that most of you maybe got an email about yesterday from Rob Hamilton announcing it. So Kate Nass, our CFO, and it's going to be starting on July 1st, 2025, which is fiscal year 26. The increase will go from 5,000 to 10,000. I'm not hearing any hurrahs, but all right. I mean, it's kind of cool. It's something, I mean, 5,000 is very low. So 10,000 is a much more reasonable amount, and it's in line with the uniform guidance threshold increase for equipment. So we're in line with the federal government right now. And what does it mean for agencies? It means that there will be comp objects that are updated, and that will occur after month 13 is closed. So that way it's not confusing. We're going to see the new, because it's going to be retroactive. So it's going to happen after month 13 is closed, and we recommend that the disposal of your assets that are below 10,000, because I'm sure you have some that are below 10,000, will need to be disposed of, and we recommend that you do that after the close of month 13. And then after that, we're going to update the OEMs because we have a lot of references to 5,000 and objects and everything. So we're going to do that in fiscal year 26. Not right off the bat, but we're going to get that updated soon after this change happens. The second part of the news is that there's going to be a new SARS and OSC website. It's in the works right now, and the first stage of it is basically building the umbrella OSC website, which is going to be done by the end of June. And then under that, in that website, it's going to link to all of our individual websites like SARS, Swarm, SFMS. It's still going to be linking to our existing websites. Nothing is changing about our websites currently. And then after month 13 is passed, we're going to actually make the updates to our website. So the links will change, how it looks will change. So we're trying to keep it as consistent as possible for your employees, because it's not fair to go, hey, here's where you can find this information. By the way, we changed it a month later. So it's staying consistent. You guys will be able to find everything that we talked about in the training today. So are there any questions, thoughts, opinions? Excited? Excited? Okay, I like that. Any questions online?
One for Heather.
God. I can already tell you that I misspoke. I think I said 6 digits when it was supposed to be 7. So I will correct myself there.
Oh,
The
well,
first digit being something other than a 1. That's what they're
you say, what would be an example of a
questions for me.
non-gap
All right.
gap?
Under,
a non-gap gap.
Yeah,
Um,
you want to get back to me on that?
Yeah.
Okay.
under million, I'm still gonna have to figure out.
So anything that you saw that you're like, huh, that doesn't look right on the slide, and then we noticed it too. So we're gonna make changes to our slides. We're gonna post them to our website. You're all gonna get the correct slides when we publish them. And I just want to say thank you all for coming in person and being there online. This was a really great turnout. This is the biggest turnout that we ever had on the day of the actual training.
Yeah.
And just want to say the work that agencies do is so integral for the accuracy and the timely reporting of our financial statements. So we really appreciate the work that you guys do, because together, like, that's the only way that we can do our effort. And so we really appreciate everything that you guys do for us.
Sorry, for those online, I'll speak louder. But disposal of assets below $10,000, would that be a 10,000 fair value or actual value? They're saying
The original value of the assets, not the net book value. It's what you purchased that asset for. $7,500. It would be gone.
someone is asking if we can send an email that summarizes the changes we made to the slides.
We could do that. I mean, just like saying, there should be only a few. I saw 1 GL and then a date. So like, we can do that, certainly. Is that it? No more questions? 15 minutes early? Not bad. All right, well, thank you, everyone.